Module 5. Interest. Using Excel in interest rate problems. While there are algebraic formulas for almost all financial calculation problems, at this point, those formulas are going to start getting really complex. So let's discuss some fundamentals of solving interest rate problems with Excel. You can also use another spreadsheet program, such as Google Sheets. There are 5 basic components in each problem involving future and present values. 1. The interest rate. This is the interest rate per period, usually per year, but sometimes per month. In Excel, this is the rate. 2. The number of periods. This is the number of, usually, years or months in the problem. For example, if you're holding an interest-bearing account for 30 years, the number of periods is 30. In Excel, this is NPER. 3. The present value. This is the amount your investment or annuity or whatever is worth now. In Excel, this is PV. For the future value, this is the amount your investment or annuity will be worth at the end of the term, which is the end of the number of periods specified in the problem. In Excel, this is FV. 5. The payment. This is the amount contributed to or from the account or annuity in the question each year. For example, if you have an interest-bearing account, and you contribute $1,000 to it each year for 10 years, the number of periods is 10 years, and the payment is $1,000. In Excel, the payment is PMT. Note that when using Excel, you can't always just use positive numbers. Money going in one direction must be negative and the other direction positive, to indicate that the money is flowing in opposite directions. For example, if you contribute $1,000 and it grows at 5% per year for 10 years, the future value will be $1,628.89. However, Excel will give you the answer as negative $1,628.89. Since the amount going into the account was positive, the amount coming back out is negative. If you used negative $1,000 as the present value, the future value of $1,628.89 will be positive. It doesn't matter which direction is negative and which direction is positive, as long as you're consistent about it. To solve for any of the 5 quantities in Excel, simply type equals and then the Excel name for the quantity, such as equals FV and then open parentheses, which is Shift 9. Excel will prompt you to input the other quantities at each step. Let's look at an example. Assume Patty wants to take out a loan to buy a car. She needs a loan of $20,000 and can get an interest rate of 6% per year, which is 0.5% per month. The loan will be for 5 years, or 60 months. How much will her monthly payment be? We are looking for the payment, so we put equals PMT in an Excel cell and open parentheses. It prompts us for the rate, which is 0.5% per period. We'll put in 0.005, since that means 0.5%. Then, it prompts us for the number of periods, which we put in as 60. Next, it prompts for the PV, present value, which is negative $20,000, since she's borrowing $20,000. You could also put in positive $20,000, in which case the payment's answer will be a negative number. Either way is fine. Finally, you're prompted for the future value, FV, which is 0, since at the end of a loan term, by definition, nothing is owed on it. For the last prompt, just use 0, as almost all loan payments are due at the end of the period. Then, we close the parentheses and click Tab, and Excel calculates the answer as $386.66. Thus, Patty's monthly payments will be $386.66. Note that if we changed it to a 4-year loan, we could simply change the number of periods to 48 months and Excel immediately recalculates the loan payments as $469.20. We'll be using Excel for many of the complex problems in the course from here on out. Interest rate. An interest rate is a percentage charged or paid on a principal amount, usually expressed as an annual percentage rate, APR. It is the cost of borrowing money or the reward for lending money. The interest rate can be simple or compound, depending on how it is calculated. A simple interest rate is calculated based only on the initial principal amount borrowed or lent. In contrast, a compound interest rate is calculated based on the initial principal amount plus any accumulated interest. Interest rates can be fixed or variable. A fixed interest rate remains the same throughout the term of the loan or investment, while a variable interest rate may change based on market conditions or other factors. Interest rates are used in various financial transactions, including loans, mortgages, bonds, savings accounts, and other investments. The interest rate is critical in determining the cost of borrowing money or the potential return on investment. Higher interest rates imply higher borrowing costs, discouraging individuals and businesses from taking on debt. On the other hand, higher interest rates can also offer higher potential returns for savers and investors. Various factors influence interest rates, including inflation, government policies, central bank policies, and market forces, such as supply and demand. A country's central bank often sets a benchmark interest rate as a reference point for other economic interest rates. Interest rates are vital in finance and can significantly impact the individual and the broader economy. Assume Matthew wants to take out a loan to buy a car. He calculates that he can make repayments of $5,000 per year. How much car can he afford, or how much is the maximum price he can pay, assuming yearly payments with an interest rate of 7.9%? Well, the algebraic formula for present value is present value equals payment times 1 minus 1 plus the rate to the negative power of the number of periods, divided by the rate. Of course, it's a lot easier to use Excel. Start with equals PV since we're solving for the present value. Open the parentheses and input a rate of 0.079, which is 7.9%. Put in an NPER of 4, since there are 4 periods, i.e., years, in the loan. A PMT of $5,000, or negative $5,000, if you want a positive answer. The FV is 0 and the type is 0, as in the previous demonstration. Excel quickly gives us an answer of $16,597.56, which can be rounded to $16,598. Of course, it's unusual for car payments to be made on a yearly basis. Usually, they're made on a monthly basis. But the example should serve to illustrate the point. Internal rate of return (IRR). Internal rate of return (IRR) is a financial metric used to evaluate the potential profitability of an investment or project. It represents the discount rate that makes the net present value (NPV) of an investment equal to 0. The IRR can be calculated using a series of cash flows associated with an investment or project, such as initial costs, future revenues, and expenses. The calculation of IRR assumes that all cash flows are reinvested at the same rate of return as the IRR, known as the reinvestment rate. The IRR is a valuable tool for comparing different investment opportunities because it provides a single percentage figure that summarizes the potential return on investment. The higher the IRR, the more attractive the investment is. The investment is considered profitable if the IRR is greater than the required rate of return or the cost of capital. If the IRR is less than the required rate of return, the investment is considered unprofitable. IRR is commonly used in capital budgeting to determine whether a project should be accepted or rejected. In this context, the IRR is compared to the required rate of return or cost of capital to determine whether the project is expected to generate a sufficient return to justify the investment. Overall, the IRR is a powerful tool for evaluating the potential profitability of an investment or project, and can provide valuable insights for decision-making in finance and business. To calculate the internal rate of return (IRR) for the investment, we need to find the discount rate that makes the net present value (NPV) of the cash flows equal 0. Thus, IRR problems can be solved with Excel by solving for the rate, while using a present value of 0. For example, assume that for an initial investment of $10,000, you expect the project to be worth $13,382.26 in 5 years. What is the internal rate of return? To answer this question, you can solve for rate in Excel. The number of periods is 5. The payment is 0 because there's nothing being added on an annual basis. The present value is $10,000, while the future value is $13,382.26 and, as usual, the type is 0. Excel solves the problem as being 0.06, or 6%. APY and APR. The effective annual interest rate, EAR, also called the annual percentage yield, APY, is the interest rate that reflects the reasonable or practical cost of borrowing or the actual yield of an investment over 1 year. It considers the compounding of interest, which means the interest earned on prior interest, and expresses the interest rate as if it were compounded annually. Annual percentage rate, on the other hand, commonly called APR, means the amount of interest earned over the course of a year without considering compounding. For example, if the APR is 6%, this means that you can break the monthly interest rate down to 0.5% per month. You can simply divide the APR by 12 to get the monthly interest rate. The APY in the case of a monthly interest rate of 0.5% would be a bit higher than 6%, about 6.17%, actually. APR is more useful for day-to-day loan calculations because it allows the easy conversion of yearly interest rates to monthly rates. On the other hand, AR/APY is more technically accurate. Either way, they're just different ways of saying the same underlying rate. In Excel, you can convert APR to EAR/APY by using equals effect and putting in the parentheses the APR and then the number of periods per year, i.e., 12 if it's a monthly transaction. Likewise, you can convert EAR/APY to APR by using equals nominal and putting in the parentheses the APY and then the number of periods per year. For example, if a bank offers an APR of 5% compounded quarterly, the EAR would be 5.116%. It is higher than the nominal rate of 5% due to the compounding effect. Term of a loan. The term of a loan refers to the time a borrower is expected to repay the loan in full. It is typically expressed in months or years and is agreed upon by the lender and borrower when the loan is granted. The loan term is essential as it determines when the borrower has to make the required payments and repay the loan. A longer loan typically means lower monthly payments but higher overall interest costs, while a shorter loan term usually means higher monthly payments but lower overall interest costs. For example, a mortgage loan with a 30-year term means that the borrower has 30 years to repay the loan in full, while a car loan with a 5-year term means that the borrower has 5 years to repay the loan in full. The loan term is usually specified in the loan agreement, along with other terms and conditions such as the interest rate, payment frequency, and prepayment penalties. When considering a loan, it is essential to understand the term and how it will affect your monthly payments and the overall cost of borrowing. Borrowers should choose a loan term that they can comfortably afford while minimizing the total interest paid over the life of the loan. For example, assume a restaurant purchases a commercial oven for $75,000. Assume the loan rate is 6.6% APR with monthly payments is taken out to purchase the oven. The monthly payments are $800. How long will the loan be? To find the term of the loan, we can solve for number of periods, NPER, in Excel. The rate is 0.0055, which is 6.6% divided by 12, or 0.55%. The payment is negative $800, since $800 is being paid out each month. The present value is $80,000, since that's the amount of the loan. The future value is 0, as in the end of most loans, and the type is 0, as usual. Excel tells us that the term is a little over 132 months. After the 132nd payment, there will be a nominal amount of principal remaining.